And welcome to Hitting Home with Mike and Arif. And it's been another week full of information, another week full of headlines and statistics and data.
Yes,
and
it has.
Mike.
And we always look, okay, what are we going to talk about this week? We've talked about everything, and it never fails. Another week goes by, and there's more things happening in the news, in the community, in the province, across the country that gives us stuff to talk about here.
We're certainly at a point, though, in history, or the present, if you will, where everything is changing. There is a lot in flux. There are local influences, there are slightly more macro influences, and then, of course, there are global influences, and all of those influences do impact those who are trying to throttle or revive or find stability within the economy. And so if you look around the world, whether it's global conflict or whether it's recessionary or supply chain influences around the world, that's all having pressure.
Oh, it is.
And of course, it really does trickle down to your life, my life, and how we make decisions at home. So what's happening at home, Mike?
And at the same time, just to add to that, and we always look to those traditions and patterns that we see every year. And one of the most significant ones is the spring market. That spring market comes around, but it's not always guaranteed it's going to do exactly what it did last year or the year before. In fact, in recent years, we've realized that a lot of those patterns are not as reliable as they once were. There's far greater influences, but nonetheless, spring is the time of year when many people's thoughts turn to buying and selling a home.
Sure, but to look at why those things really aren't as reliable as they were for the last few years, well, the question is really why, and I think one could safely argue that for the last several decades, we've conditioned ourselves into certain habits and patterns and certain expectations, and that really did get thrown out the window in the last 3 years. So there were other things that were influencing those patterns.
Certainly within the last year or two, and you know, we're at least a year we're well into that period of watching interest rates climb from historically low points that they held for quite some time. The impact of that has been a quieting of the real estate markets, which was by design, really. The market had run away. Government, the Bank of Canada was looking to kind of quell that a little bit, and it's worked to a degree. But now, again, we're coming into that spring market, and if you look to the GTA, it's interesting. You can kind of look to the U.S. to see what's happening there economically, and usually that's the lightning, and we get the thunder a little bit later here. Same to a lesser degree is watching that GTA market, what it's doing there, and more often than not, we follow not far behind with the same sort of behaviors or reactions. And what we're seeing right now in the GTA, if you look at the data that just come in the past week, the Korea market statistics, it shows that the home prices in the GTA, or not prices, but the home sales activity increased by 44% from February until March. Now, at the same time, the level of inventory, the existing homes for sale, dropped by 44.25%. So you've got the demand going up and the inventory supply going down. And what does that remind you of?
Well, and that's the thing I just actually wanted to get into just a little bit. First of all, Korea, being the Canadian Real Estate Association, is giving you national statistics of about 44% month-over-month activity.
They're taking all the local data from the local boards, and then processing it and feeding it back to us.
And so you're saying that they're seeing month-over-month increase in activity, but how does that compare to normal? How does that compare to year-over-year? But as you also said, what I heard you actually say is that the amount of homes that are for sale has increased, but also the relative consumption of available homes has stayed in line.
The number of homes being purchased is going up. It's still far lower than it would have been a year ago.
Right.
Like, all the numbers are lower right now.
Right.
But it's more, this is a reflection of the behavior within the market using numbers. and we're seeing more homes being sold than the previous month. But again, the inventory numbers are down. And what is more traditional, if you want to look at that traditional typical spring market, is you get into March, April, May, you see the volume of sales going up, but also coinciding with that, you will see the volume of homes being listed going up. We're not seeing that. We're seeing activity, the number of purchases going up, inventory numbers going down. And if you go back to 2019 into 2020, that's precisely what was happening.
If inventory
then.
numbers are going down and home sales are going up, you're going to see more pressure on the demand side.
That's it.
And therefore
Which
the sales prices are going to go up.
we should talk about here. Is there a possibility we may start to see home prices going the other way? We've seen them quietly going down, down, down over the last year in response to the increased interest rates and lower purchase activity. If the purchase activity is going up but the inventory levels are going down, there's the potential there for home prices starting to go up a little bit, and maybe even start to see those multiple bids again.
A couple things that I'd like to know, though, is at what price point are these homes? Are we seeing this activity? Is it the average home price in this region in around the 800 mark? Is it the 1 million plus in the GTA?
There's activity at all levels, but the level of activity in the high-end market, which let's say 900,000 and up, that activity has gone down dramatically. There's far less. Where you're seeing sustained activity, and if not increased in some pockets, is that lower level. Because as interest rates went up, you still had buyers who wanted to buy, but the $800,000 they might have otherwise bought when interest rates were 1.9, now they're going, I can still buy a house, but I need to focus on that lower price category.
So here's the interesting question for me. Is it the buyer that a year or two ago would have been looking in the $1 million range, now looking in the $750,000 to $800,000 range? Is that who it is? And that's an interesting question, right? You got to remember, is it people realizing, well, one, I want to buy, but I now have to buy within my means because interest rates are, like the benchmark's up 400%.
That's a definite reality and reflection of what is happening.
So it's not necessarily that that the
average home price?
Exactly.
And we've talked about this, you've heard me say, when the average is a reflection, what's the average prices of homes that have been sold? If the average home price is down 20%, it doesn't automatically mean that home prices went down 20%.
Exactly.
It means people are spending 20% less on homes because many of them are buying. It's a combination of both. Home values, individual home values have gone down somewhat, but it's a smaller fraction of that number, which is the average home price. And the average home price, or average price of homes sold in any given period, is a reflection of where people are buying as much as it is on the value of the home.
Again, so the point to drive home is it doesn't mean that home values have decreased. It means the price point.
Well, but it's a combination, but not. It doesn't mean that average sale price drop does directly correlate, I'm just losing the language here, directly correlates with a drop in value of the home.
Exactly.
It's a change in the purchasing behavior.
And that is critical. And again,
combination of the two.
When you're looking at it, well, why is this a fact, right? Why is this, and who does this help, and who does it actually challenge? Because if you have people who otherwise were looking in different price points, now competing for homes in a slightly lower price point,
that's going to protect the prices at that. At the same time, those who do have a home in the higher price range market, who aren't seeing the activity, who aren't seeing the multiple bids they might have seen a year or two ago, now there's pressure on them to bring their price in line. If I've been listed at $1.2 million for the last 2-3 months, and I've had 4 people look at my house, but I've had no offers on it, but I'm determined to sell, well, the only option you have, provided you're doing all the marketing as you should be and you're staging your home the way you should be, if you're still not getting the results, then the only thing left to do is start bringing your price down to try to attract the buyers. And that therein is where the pressure and why prices change.
Exactly, and I think that that's really critical because I think when you look at people's behaviors, there are people, and it's not a run on the bank, so to speak, but there are people who have said, maybe I bit off more than I can chew, and I need to get out, or maybe my circumstances changed and I need to get out. Those who are sitting well, in a good position, who can manage their monthly obligation, may be more inclined to wait it out and see what happens in the next 3 to 6 months. What happens with the market? Will rates come down?
Yeah.
And if rates do come down, will that re-incentivize people and reinvigorate people to go and buy? Great, they might hold on to their home, but those who are feeling pressure for one reason or another, maybe they've got a change in lifestyle, or maybe they've got a change in economic
there's a lot of reasons for those decisions, and change in lifestyle. Empty nesters, obviously, I don't need as much house. People, maybe they've been empty nesters a while, but have chosen to stay, and now it's gotten to the point where, you know, the knees and the hips are hurting a little more. I don't want to be climbing up ladders, cleaning out gutters, and spending my Saturdays on the lawn boy. And but you're also going to see some people, not just to make it less expensive month to month to carry a home, wanting to downsize. So a lot of people have a lot of equity tied up in their home. Anybody who bought, you know, as we pointed out here many times, if you bought in 2017 or previous to that, you without doubt have at least doubled the value in your home. So if you bought your home for $400,000 and it's worth $800,000 today, you've got $400,000 in equity. It's not an ATM machine per se where you can just go and borrow a couple $100. There's a process. You can borrow against it and remortgage. But the other alternative is, okay, if I move from my $800,000 home into that condo that we plan to, you know, move into at some point, let's do that now, free up $200,000, $300,000, $400,000 in equity, and we can do some of the things we want to do. You know, do some travel, you know, update the cars, whatever your need or goal is for that money. A lot of people are motivated to downsize for that reason, to free up equity. So,
yeah, and it is an interesting time. The spring market, as you said, has been something that we had come to become familiar with over the last, I don't know, decades, generations. Certainly the last couple of years have thrown a bit of a wrench in that. Do you predict people going back to sort of their old ways, their old habits and expectations? Or one of the questions that we've been asking ourselves recently is, do we believe that the recent challenges and the recent uncertainties were enough to sort of jolt people into embracing new patterns, new behaviors, and new realities?
I think that pattern will remain. The reasons why we have a spring market continue to exist. What's changed is the volume of people who are participating. That's the raw numbers are changing. So even though I'm saying it looks like, you know, the GTA is starting to see prices increasing, even though prices are increasing, the people who are buying, it's a much smaller pool of buyers who are qualified and able to buy right now than a year ago. And we'll talk more about that as we go forward. But if
the
you look at
consistent
that
thing
spring
is,
market,
though, spring is green grass, it's rejuvenation, curb appeal, getting ready to have something for summer.
Yeah, you know, we're more enthusiastic. Once the snow is melted, we can see our homes, we see the flowers starting to come up. A home never looks better than it does in those first few weeks of spring when everything's blossoming and blooming and the grass is turning green again. But and so as far as curb appeal goes, spring is a good time to sell. But there's another factor I just want to throw in quickly, and that is people want to time their sale over the summer when their kids are out of school. No one wants to pull their kids out of school the last 2 or 3 months and move them into a new school. That transition works best over the summer. So that's why
with that in mind, Mike, we talked about a few good things here in terms of natural process, natural behavior of the consumer and the marketplace. When we come back from the break, I think something that we have been talking about over the last several weeks, and certainly will probably continue to talk about, is artificial manipulation of behavior. So when we come back from the break, let's talk about what are those forces that are at play, whether it's regulators or whether it's marketplace
manipulators.
Manipulators, absolutely. So stay with us for more of Hitting Home with Mike and Arif, and we'll be right back after this break.
Welcome back to Hitting Home with Mike and Arif, and this is Arif and Mike here trying to make heads and tails out of the Canadian Real Estate Association numbers that have just come out for the month of March. And taking those numbers and looking at them and trying to project ahead and see what they mean to the market right at the moment, first of all, but what they may mean going forward. We are into the spring market. There are typical behavior patterns that don't always follow the previous year's patterns, but to a certain degree they do, and that is there's heightened activity of buying and selling that typically takes place in the spring, as we spoke of previous. But it is interesting, given those numbers and how we are seeing an increase in purchase volume over the previous month, and a decrease in inventory especially. This did happen in 19 leading into 2020, and that was the beginning of the pandemic, and it also sparked that real estate frenzy that we saw that continued on for 2 years. I don't think we're going to see anything like that today, because a key component of that was the fact that interest rates were at historical lows, and as we know, interest rates now are where? Around 4.9, 5.9, in that range?
Yeah, the benchmark made is around 4.25, but your average preferential rating is around 459 to 489, something like that, yeah?
So that in and of itself has raised the bar and probably squeezed a lot of people who otherwise might be buying a home this year. It squeezed them out. It's also squeezed out a lot of the novice investors, the speculators who may want to get in and dabble with real estate, buy that house, fix it up and flip it. The bar to entry has gone up so much that some are going to back off from that. The more squeamish are still a little nervous about whether or not the market has bottomed out.
Yeah, well, I've got a perspective, Mike, that basically says this. There will be those who will list and make their home for sale. Why? Because not everybody else is listing their home. And in that scenario, they might be looking to take advantage of a larger buyer pool.
Mm-hmm. Those
right?
who are savvy enough will see that.
But I don't think the average
far more of the population will think, well, if they're not putting their house on, there must be a reason I'm not going to put mine on either.
Monkey see, monkey do.
Yeah.
Absolutely. And there is a certain amount of that. So again, remember, we are talking about smaller numbers, and we're talking about averages of smaller numbers, and you're talking about the patterns that you're seeing that could sort of predict future behavior.
Yeah.
And I totally agree with that. At the same time, I do think that you said people are a little bit skittish, or maybe that's a word that I'm using, but I do think that people are paying a little bit closer attention, because forget about headlines and forget about numbers. The average person who's having a conversation amongst friends and amongst peers is saying, you know what, I hate to admit it, but I'm watching what I'm buying now. I'm filling up half a tank of gas because the new carbon tax came in, and that instantly jumped gas prices at the pump by 10% or whatever, or 10 cents. So every little area people are being mindful of, because there is some uncertainty. We're also talking about the fact, as you said, listen, in the last segment you talked about, well, the government really wanted to calm things down, and I think that they did that. Well, sure, they sure did it. Yeah. But at what expense? And in whose life did they really impact? So we're talking about some buyer activity coming into the spring market, and for sure, which is now, I think we agreed last segment that it's redirecting what price point that same buyer is now shopping in, because they're factoring for other things in their budget.
Yeah, and instinct will tell people to be cautious when there's change or a certain level of volatility within the economy. That instinct is there, but then there's also that intuition that people have that, okay, with change, there is opportunity. Not all of us think along those lines, but the opportunity that presents itself right now for buying a home is, yes, you're going to be paying a little more on a mortgage, but you could probably set up your financing in such a way that you take a hit for the next year or two in order to get your foot in the door. But the offset of that is, I'm in a market today, flashback a year or two ago, I would have had to just blindly throw a bid on any home as soon as I saw it and hope like heck that I'm going to get that home, and good chance you were going to get outbid by someone else. Today you have some time to take your time, go in, look at all the fine details of a home, get that home inspection put in place, know everything about that home to be aware of, and go into that home eyes wide open. There's a lot of value in that for anybody. Plus, you can take the time and look through a greater number of homes and arrive at that true home of your dreams rather than just having to buy the next one that presents itself. So that's a good thing,
too. I think you make a very good realtor. I'm looking at it from a different perspective, though, and I am honestly suggesting that you know, I think when you're looking at rates that were in the 1% to 1.9% range, and that same person is now looking at 5, 6, 7, 8%. And why am I suggesting that the person who was looking at 1% might be looking at 5, 6, 7, and 8%? It is because the statistics are showing that people have made less contribution towards their regular periodic obligations. What does that mean? It means that they've maybe been paying their minimum on their credit card. Some people have been late making their payments on their credit card. Some people are getting collections notices. Some people are taking second mortgages. Some people are deeper into their lines of credit.
And those are the people who are falling below the bar.
Those are the people who are falling behind the bar.
Out of the market.
So there will still be opportunity for somebody to get a good find out there. Absolutely. I'm suggesting to you, though, that the average person who's walking through the door, coming home at the end of the day, is saying, more of my after-tax income is going towards fees and interest rates and servicing debt than actually money that I can utilize to run my life or make a purchase.
There's a big segment of the population as well who will just look at that more or less as the cost of doing business. Do you not think they are going to continue to act? That person who has that home right now that's worth $2 million in the GTA somewhere, who wants to relocate and in the process is looking to lighten the load with by buying a home at a much more competitive price in the Barrie region. That activity has continued and will continue, I believe.
I think that there will be a component of the market.
Those raised interest
there will
rates.
be a component of the market that is able to do that. However, it's qualifying for a mortgage if they need one.
Yeah, well, that's the other side of that. Is there's many who don't even need, who are buying cash.
There are some who are buying cash. There are maybe many who are, I don't know what many is in terms of percentage, but there are some
percentage is probably
who are.
Continued.
But anybody who needs a mortgage, and this is something that is going to weigh future, in the future, depending on if it passes the scrutiny that's coming up this month, towards the end of the month, is the regulators looking at, well, what other ways can I make life difficult
Throw
for people?
a bump in the road, another hurdle.
That is the way that the average person is interpreting that. They're not saying, well, what is the most responsible way we can do it? They're like, oh, you're throwing another obstacle at me. But so here's the number that's being looked at. It doesn't matter how much equity you have because it matters on how you have serviced your debt and how you can service your debt. So you may walk into a situation with a lot of equity, and that's great, favorable. Sell for $2 million, buy for $800,000 if you had some equity in there and you're in good shape. But if you need a mortgage, it's going to come down to debt servicing and how you have serviced it in the past. And even if you hit 1 or 2 or 3 months in a row that were sort of a little bit bumpy and you're like, oh, okay, I'm going to recover now, or now I'm uncomfortable enough that I'm going to make a move and buy somewhere that's more affordable. The question is, did you make this move before it impacted your credit worthiness or not? Because if it impacted your credit worthiness, you're not getting in at the preferential rates, and if you're not getting in at the preferential rates, you might be paying 7-8%.
Another influence in there, just take us in another direction for a little bit here, and we've talked on this before, and it's probably worthy of a show all on its own. It's what's happening in the commercial market with regards to office space, particularly people who do work in an office environment. We see the 400 fill up with cars we have traditionally, everybody heading down to the GTA. More and more people are doing the work from home and continuing to do the work from home. Many of them have gone back to the office environment, but many of those office setups in downtown Toronto are being reevaluated, and you've got companies that are downsizing to smaller offices, maybe in the suburbs where they're paying less per square foot. They're deciding they need less square footage because they're not bringing the entire staff. It's either been, honed a little bit down and the staff smaller, or they're working from home part of the time and only in the office another part of the time. Lots of different scenarios that really add up to a decreased need for real estate. And even though we talked about real estate prices going up in Toronto and demand going up in Toronto, the price and the demand for commercial, particularly in the downtown GTA, is actually being challenged right now because the vacancy rates are going up tremendously. They're not filling those spaces as quickly. And it's interesting what will happen with that, if that will reverse itself at some point. I don't think it will. I think our whole work-life scenario has evolved and has evolved quite quickly in the last few years.
Let's touch on that for a second. Why would it, what would make it reverse itself versus what would make it stay? And if I was to look at it, Mike, and you and I were talking about this, we talk about this on the regular, is, well, why would it revert back? It wouldn't. The only reason it would revert back is if we decided to undo the technological advances that we've made.
Well, that's the thing.
If we suddenly didn't have internet, and if we suddenly didn't have broadband, and we suddenly didn't have the technology in our favor, okay, then it might revert back. But why?
That scenario, the downtown office, it was kind of on life support to begin with because of technology. The technology had either eliminated or reduced the need for that.
So, Mike, here's the opportunity that I see.
And COVID kind of was the elixir that said, okay, now we'll do it.
You're seeing this in Manhattan, you're seeing it in Toronto, you're seeing it in LA, you're seeing it in other areas.
Yep.
You're going to see redistribution or repurposing of those structures. So what might that mean? It might mean that they take major corporate footprints and put them into smaller shared or community space or shared office spaces. Or you might see them, what they've done with lofts, turning them into apartments. You might see them going more on the residential side. That might be a larger reinvestment by the landlords, but they've made their money. And if they haven't, shame on them. That's their fault. They should have been watching the marketplace.
One of the big motivators, I'm presuming, for the longest time, if you go down into a downtown of any major city, let's take Toronto, something you saw all over the place constantly during the workday was bicycle couriers running documents from here to there. Everywhere. That's redundant technology now, the need for moving physical copies of documents. I'm sure it takes place still to a degree. I'm sure there's probably far fewer bicycle couriers actively working today than before. And that's why a lot of the industries, like-minded industries that interacted through the course of the week, located in a collective manner in a downtown. The need for that is gone.
Well, listen, if I'm driving an Uber, then I can also deliver a package as a courier, and that's the thing. So the gig economy has sort of been disrupted the bicycle courier as much as it's disrupted any other. We do have to go to break, but when we come back, let's talk about more predictions of where we see things going and why. So stay with us for more of Hitting Home with Mike and Arif. We'll be right back. Welcome back to Hitting Home with Mike and Arif, and it is an interesting time to be alive, Mike, because we've gone through, or we're currently experiencing what would normally be patterns and normally things that you and I could predict and count on in terms of our own business, our own volume, our own preparedness. The spring is around the corner.
In those patterns,
spring is around the corner, and you just knew that the market was going to be hot, and we'd have a short window because we knew people wanted to move so that they could move and enjoy the summer or before school started in the fall. These were all things that were predictable, but as we've been talking about on this show, there have been a few things that sort of played a little bit of mind games or upset that predictability. And being COVID-1, we just talked about patterns changing. Well, why are patterns changing? Well, technology came along with COVID.
Technology is an influencing factor for sure.
Just because spring is in the air doesn't mean that technology changed, right? So we've now embraced that technology. So there's new constants, there's new variables, there's new patterns, and I think we are going to have to figure out.
And the cost of money has changed dramatically, and that's a big influence on everything here.
Absolutely. But if there's one thing, though, I think we can also look at is people tend to be creatures of habit, maybe, okay? People also make a lot of their decisions based on emotion. And then there's also the facts that are sort of free from emotion. And we have to look at how is that going to play in terms of people making their decisions going forward.
Yeah. Well, you know, emotion may drive your urge and the direction you pursue with regards to buying real estate, but it will always fall back to the numbers, you know, knowing what your parameters are and staying within them.
Absolutely, but I think we both agree, regardless of what the world throws at people, there's still going to be a desire and a demand and a need for housing. And so the question will be,
the demand is key there.
Yeah.
All capital letters on demand.
Because, absolutely. Yeah. So is that demand based on immigration, or is that demand based on migration? Is that demand based on generational shift and flow and transfers of wealth?
Of all.
It is going to be a combination of wealth. And the one thing that we haven't talked about.
It's a product of the economy too. A good economy, more people are looking to purchase. Weaker economy, people back away. But we still have half a million people every year continuing to come into this country.
During the last 3 years, theoretically, anywhere between 1 to 1.5 million people would have been earmarked or pegged to migrate into the country. And that's fantastic. But one thing that also has to get taken into consideration is those who have the land and who have the approval to build property or housing. They can also read the market and determine what type of house they're going to build. So are they going to build more free standing detached homes? Or are they going to build more multiples? Are they going to build more high-rise condominiums?
The pressure is there by government. And just on that alone, me saying that, it's unfortunate, but our government thinks pressure is a better motivator than incentive with regards to real estate. And that's their big principal failure, is when they look at the challenges that we face in real estate, they tend to put measures in place that are pressures and limiters rather than putting incentives in place. You want to get houses built and built fast, put some incentives in there. Don't put pressures on. And a perfect example of that is the changes that have just come about or about to be turned into policy, and that is with regards to, it was January of last year, measures were put in limiting the purchasability of foreign buyers of real estate in Canada. It was an across-the-board decision by the government, and the thinking was, well, if we eliminate foreign buyers, that'll take some pressure off the market, that'll open up opportunity for domestic buyers of real estate, and quite likely start to bring prices down. In hindsight, as the government often realizes with their hindsight, is that the results we hoped for, we're not seeing. And so now they're reversing, and they're starting to make some changes to policy. And let's talk about it. I scribbled some down because I can read. But first of all, they're making opportunity once again for foreign purchase of real estate. And the reason why, something they totally glossed over or didn't see altogether, is the foreign buyer is not just the person who's buying a condo and running up the bids on that condo or house in Vancouver or Toronto.
The ghost hotels and stuff like that.
They're developers. Yeah. Many of them are buying the raw land to turn around and develop and build the houses we need. So the government's realizing we've just stifled a lot of the home development that would have otherwise taken place and helped us to get through all of this. We've actually made that scenario worse for Canadians by doing this. So they're reversing and they're backing off on some of those decisions.
What's interesting is that they failed to realize, or maybe they did realize it, but thought that no one would catch on. But an entity can purchase property.
Yeah.
So just like you and I as human beings can purchase property,
so can a corporation.
A Canadian corporation can purchase property. Mm-hmm. And all it takes is for someone from outside of the country to go and visit their lawyer and have that lawyer set up a Canadian corporation. They become a partial shareholder in it, and it might not be a majority shareholder. Speak to your lawyer. I'm not giving legal advice here today or tax advice. But the reality is that Canadian corporations have the same rights as human beings to buy a property.
Yep.
So that did happen, that has happened, and again, it was just quick knee-jerk temporary measures or short-term measures to try and stifle things and to try and correct them, when in fact, if we look at who's responsible, Mike, and this is the thing, who's responsible for the situation that we're currently in? Is it the regulator? Is it the legislator? Is it the banks? Is it the consumer? And I'd argue that it's all of the above.
We all own a piece of that, but I think first and foremost, it is the regulator, it is the government, it is the lenders, and it's all the decisions that are made there. There were decisions made that created a frenzy type market at those levels, and there were decisions made to back off on it.
So I'm going to poke the bear just a little bit and say, if this was many other countries around the world, I believe the electorate would be far more vocal, far less passive. And Canadians, by default, have been passive people, and we have allowed our regulators to do whatever they felt like doing. And if that was in the States, I think you'd see people losing their seats a lot quicker in sort of Congress or Senate or state representative positions.
And we're a little more complacent, and the U.S. was a little more at one point. I know the U.S. as a republic, they're all about their individual rights and freedoms. Canada, we're a little more still got some of that old.
So that's what I'm saying is that we as Canadians just sat by and watched and said, oh, I wonder what this guy's going to do to the rates today. Oh, geez, that doesn't feel good. That hurt me. And instead of getting disappointed and upset and sending mail to the members of Parliament and putting pressures on our elected members, we just sort of sat here and took it. And I don't think anybody's going to like that I'm saying it, but it is kind of the truth. That's what happened, right? We allowed for a period of 10 years to sit at unreasonably low rates. And this is why I'm saying, yes, I agree with you, it's the regulators. They're the ones asleep at the wheels. They're the ones who led us poorly, and we allowed them to do it because we sat at unrealistically low rates for such a long period of time, and then we let them raise the benchmark rate by 400%. That is
the problem. I don't care they gave us all
brought
economic
it to a more
whiplash.
Normal rate. That doesn't matter. They did it in a way that was unsustainable.
Well, it's too much too soon. They literally, over the last year, what they've done, it's not sustainable, and it's not without collateral damage.
It's irresponsible,
still
actually.
Unfolding.
It actually is irresponsible because while there is a benefit of bringing us to more normalized rates or reasonable rates, what the damage that has been caused in the economy, layoffs. Remember what we talked about before, not so long ago. When we see reporting today, we're not seeing today's numbers. As much as we live in a real-time era,
it's a reflection of the last quarter.
We're seeing quarterly, exactly. So if you look at the recent polls, and there's several thousand people being polled across Canada right now, looking at where they currently stand financially, 47% and more Canadians are saying if the rates move, we're in a lot of trouble. There are other people, 76% of people saying...
Move as in move upward, anyhow.
Move upwards. 76% of people are saying they are $200 away from being insolvent. What does that mean? It means $200 away from not being able to meet their obligations. That is the average person. I don't care whichever way you slice it. The average person is in a very precarious position right now, and we allowed that to happen. And I think that's irresponsible.
We're in volatile times, without a doubt. Historically, we've been there before, and historically, we always find our way out. And historically, there are always some casualties too. And I don't say that in a just fluff it off kind of way. That's
76% though isn't some casualties. I think 76% is a pretty stark number. So,
what does our government typically do if it gets to that point where these people are going to fall off a cliff? Of course, we'll give them money.
You heard it here first on Hitting Home with Mike and Arif. Here's what's going to happen, Mike. We are in the middle of, we're quickly approaching the middle of 2023. We're going into election mode in 6 months.
Well, that's going to change the dynamics considerably on how government approaches all of these problems.
Yep, so somebody's planning to come out with some save the world solution that people are going to buy into. And
well, there'll be...
The numbers still don't lie, though.
There'll be different levels of fiscal responsibility within the policies and promises presented. And you can imagine for yourself which party is going to come out with which.
With which policy. Absolutely.
There'll be the carrot and there'll be the stick, and you decide what we need right now.
So while we are going into seasons, we're going into actual, meteorological seasons, if you will, or weather patterns, Mother Nature seasons. We're going into economic seasons. We're going into political seasons, and all of these things are going to play a role. And so I do think that while we're going to see some activity, those who are paying attention to the numbers, and again, remember, we've got major employers, we've got the other component, which is small business, which actually employs more people than large corporations do, right? So that has an impact.
Job numbers are looking good, but I don't know if they just haven't caught up to
I don't think they've caught it yet. I don't think they look that good.
Well, probably the best introduction to any book I ever read, going back to school days, the first sentence was, they were the best of times, they were the worst of times. I think that kind of explains where we are right now.
Yeah, I do think that, and again, that same article that I was reading, I believe it was the Globe, but it was an Ipsos poll, did say that over 52% of Canadians are saying, yeah, things have been tough, but the numbers haven't rolled in yet.
There's
we
caution,
haven't seen it yet.
There's concern, but then at the same time, there's the consumer confidence levels have kind of bottomed and are starting to come up again. And I think some will be able to say, I can't say with certainty, but I'm curious if everything we've talked about here indicates that housing prices have bottomed. If those who have been waiting for prices to bottom out before they got in, this may well be that moment where prices have bottomed. And something tells me we have hit bottom and we are going to start to return. And I think I can't know with certainty, but I think the interest rates have nowhere to go but down if they change at all going forward. I think we've kind of hit a peak there. I sure hope we have.
Well, interest rates actually have started to drop ever so slightly. I wouldn't put any money on it whatsoever. I wouldn't call it a pattern. I would just say you're right. They probably hit their peak and then are sort of leveling out, but I think all indicators from the Bank of Canada say they're not lowering rates anytime soon.
So to summarize that, all the worst case scenarios, all the extremes that were anticipated, we may have kind of hit those, and now we're correcting back to a more moderate. That's the optimistic look at it.
So at the end of the day, we do have to go to break, and when we come back, we're going to talk about, well, what pressures does it have on the buying and selling market? What pressures does it have on what we're building? And also, Mike, don't forget, we've got people who are looking to get into home ownership. What pressures does it have on the rental market as well? So lots of things that we can still talk about when we come back from this break.
Summarize it all when we get back.
Stay with us. We'll be right back. And welcome back to Hitting Home with Mike and Arif. And we have covered some ground, and we've covered some differing perspectives, and we've been talking about who's been manipulating what. And really, at the end of the day, Mike, what are we to believe? And what are we to take away from all this? And how do we ready ourselves to be prepared for the future?
Well, it's understanding where are the pressures coming? That's the interesting question for me. Is it's a chicken and egg scenario? Is it the consumer and their behavior and activity that influences the market, or is it government, the regulators, the lenders, or is it a combination of both? I think they both step in at differing times in different markets and have
you and I are in a very similar profession. We are in the same industry, if you will. We have some differing perspectives. We've got similar codes of conduct and ethics that we have to follow. But we also serve a client, and it's interesting, Mike, because at the end of the day, I think both of us would agree that we each have to do what's right for our family. We have to do the right thing for ourselves and for our family, and we are constantly being, sort of pushed around or influenced by outside influences, but at the end of the day, we have to do what's right.
Our approaches may vary in some regards in that as the lender, you're far more protective. The equivalent would be you're the doctor, and perhaps I'm the fitness coach. I'm trying to maybe push people a little further and get them motivated and get them going, whereas you're at the other end are dealing with, well, hold on a second, don't push too far, don't go that far. So there's a little bit more restraint coming from
a physical instructor, a fitness instructor would say, what's your stretch goal, right? Last time you did 10 reps, now try and do 11, or you did 10 more pounds.
It's a loose analogy, but we'll use it for here.
But there's nothing wrong with that. That's absolutely fine as long as right? Whether it's health, fitness, or finance, we're being responsible, we're being mindful with those dollars. Now, here's the thing, though.
We all have an Achilles heel.
We all do. Here's the thing, though, that I also think we both agree on, and that is this, okay? We've all been conditioned to believe over the last 10 years what was normal, what was attainable, what was a reasonable price for a home, what was reasonable in terms of inflation or appreciation.
To push things a little bit further, a little bit further.
Absolutely. And as far as I'm concerned, shame on government, shame on regulators for allowing that to happen. It is marketing.
Yep.
And marketers are supposed to do what marketers do. They're supposed to get the sale.
But
right?
government does too. Government wants us to spend our money. There's a great line from a show I used to watch. Everybody probably watched The West Wing, if you recall.
Yeah, of course.
And it was the president, they had been giving refund checks to everybody because they'd hope everybody would take those checks and go out and...
Mike, that wasn't TV, that was Canada, right? That was...
And go out and spend the money to stimulate the economy. And the president's given his assistant, Alessia, say, you went and paid down your bills and that? And he said, well, I thought the government wanted us to pay off for being fiscally responsible. He goes, we do, but we want you to do it when the next guy's president. And that's what the bottom line is. The government wants us to stimulate the economy. And if that means driving up our debt, they're willing to put up with that.
They absolutely said it. You don't have to take our words for it. Go into the archives. I'm sure it's on YouTube or wherever. The government said, spend your money.
Well, what's this $500 check that they're just handing out right now?
Nonsense grocery money. But the government also told corporations, get off of your cash savings and reinvest it and put that money back into the economy. Absolutely. Great advice. Except now what? Now people are there are layoffs. There are massive tech layoffs. The average Canadian has overspent because we conditioned ourselves to put ourselves in debt. And now we're having trouble servicing that debt. Here's the thing, though, Mike. The thing that's interesting, the thing that really rubs me, is that Canadians, particularly Ontarians, were told, you know what, we've got these stress tests in place and they're here to protect all people, the banks and the consumers, in case interest rates move. They're here to make sure that you can still manage a home. Here's the thing. It's not enough to qualify to buy a house. You have to qualify to stay in the house. And a lot of Ontarians and Canadians didn't get that lesson. We weren't told that. We weren't taught that. And I'm not saying Canadians are dumb. I'm saying that was not part of the curriculum. We were always told you have to be able to qualify to buy a house. We have never been told, and I've been saying
qualified to carry a house for
I've been saying this for 15 years. Every single time your contract comes up for renewal, if you bought a 1-year term or a 5-year term on your contract, you have to qualify to keep your home. But if you qualified to get the home at 1% and the stress test was 1 + 2, which was 3%, for those of you wondering, I can count.
And now we're at 5%.
And now we're at 5 1/4. We're at 6 1/4. And if your credit suffered in the last year because you were juggling and taking out of one pocket to pay the other, you might be at 6 and 7 and 8%. Things have shifted, and it's not a 2% bump. It's a 200% bump or a 300% bump in your rate, depending on what you qualify for today, not what you qualified for yesterday. So in terms of keeping things into perspective, I do think that people are going to do what they need to do to either buy a home or stay in their home. I do think that they're going to look at normal traditional banks, but if those are not available by virtue of the fact that they don't qualify, they are going to look to alternative lenders. And I think it's important that you get good guidance around that. It could be the right thing to do. It might be the only thing to do. But the other thing that we haven't talked about, and I really want to hit home with you for the last couple of minutes while we're here, is if you are going to get into home ownership, maybe you've got to look at bringing on another partner, whether that's a family member, a friend,
you got to create
in-law.
Revenue sharing or revenue gaining opportunities with your home.
And you may want to look at buying something where you live in the basement and rent out the upstairs, or live in the upstairs and rent out the basement, or bring other parties on.
And these are not scenarios for the rest of your days. These are temporary measures because,
like you said, if it gets you in the door.
It'll get you in the door, and we will reach a point where, I think interest rates will moderate a little bit more than where they are now. Will prices come down? I don't think so.
I don't think so.
I think every time in history when the average home price in Barrie hit 300,000, people said this is unsustainable. When it hit 400, when it hit 500, the economy always catches up. It's slow to do so, but it always does, and it will this time around too.
I have never been one to promote people to buy their dream home, and I know some people do, and I'm okay with that.
It's not the environment to buy your dream home right now. That's the thing.
Always been
this isn't 2005 where you can go and buy 3,500 square feet for a minimal mortgage, and it's not going to cost you much.
People are sort of cutting back in certain areas. They may not be renewing their insurance policy. They might not be renewing certain things. Man, they're still paying for Netflix for some reason, or Disney Plus, as the finance minister said.
For the moment.
But here's the thing. Buy what you can afford. Bring whoever you need to the table to engage with you at a proportional level, meet the obligation. And for me, real estate, you can win if you do it intelligently in increments. Do it in steps, right?
And buy what you can afford does not mean buy what you qualify for. It means buy what you can afford, which also leaves you a buffer zone where you have a little bit of money each month accumulating, because you're going to have to, there's going to be unforeseen things that happen, and you don't want someone losing a job for a month because they fell and broke their leg or anything to push you out of your home.
So Mike, you said this a little bit earlier in the show. You said you believe that where the numbers are right now and the percentages in terms of supply and demand of where they are right now allows the buyer to be in a little bit of a better position compared to where they were a year ago, where you had to sort of make your decision and commit to it within seconds. Now you've got a little bit more time. The advice that I would give, and I think you would give as well to anybody who's watching, is take the time now.
Exactly.
Meet with your broker now. Meet with your realtor now. You don't have to go shopping
Learn
this
what
second.
Those numbers are actually going to mean to you, not tomorrow, but 6 months from now, and a year from now, and 2 years from now.
I'd like to still be in business in 6 months to a year from now anyway, so I'm not in a rush. Like, let's meet now. Let's have conversation now. And if you're a good agent or a broker in either real estate or mortgage and finance, I think the message that we should be all giving to people who are thinking about getting into the market or refinancing or what they should be doing is start early and have the conversation now.
That has never been more pertinent.
Leave your wallet at home. Don't bring your credit card. Let's just have a conversation and see what we need to do.
And that's should always have been the underlying message with realtors. And sadly, it wasn't always. It was, whatever you go to. It's the first conversation, and it should be the first conversation every realtor has with their client is get down with your lender, know what your parameters are, know what your limits are, know what your risks and rewards are, know everything inside and out before you ever step in the door to look at a home.
I even saw it within the professional community of realtors and brokers, those who were calling each other out for those who wouldn't answer the phone with someone who wasn't willing to do the transaction today. Or if you weren't selling, I wasn't interested, because there were so many people who were going around as the buyer's rep, and they were losing out on bid after bid after bid, and they were like, I only want to represent sellers. And I was like, you know what? Karma's going to catch up to you, because we'll remember, right? When times are tough, we'll remember. So the right principle is the right principle no matter what the market is. Go in, get prepared, get all of the information, and make sure that you ask the tough questions. And by the way, I would say to anybody, be prepared to receive tough feedback as well. If you're dealing with someone who's only going to tell you what you want to hear, I'd think twice.
You want both parties in the transaction, buyer and seller, to be totally informed. It should never be one-sided. Everybody should be doing their job. And
with that in mind, Mike, this has been a lively conversation, but we got to go. And we'll see you next time on Heading Home with Mike and Arif.